Hey everyone, welcome to the podcast. I have a very special guest today, Bryce Gallagher, who is a mortgage loan officer. How you doing today, Bryce?
Doing well, thank you, Andrew.
Good, good. So I'd love to hear kind of what you do for clients. What exactly does a mortgage loan officer do for his clients when you talk to someone who's looking for a mortgage? Like, what do you deal with on a day-to-day basis when you're talking with people?
Yeah, so I help individuals alongside realtors purchase residential properties. And basically, big picture, not too many people have hundreds of thousands of dollars on hand. So they use an instrument or a tool called a mortgage to pay back, you know, their monthly payments over 20, 25, 30 years. So yeah, I help them find the best product and monthly payment and hopefully the lowest interest rate that's based upon a couple factors, such as their credit score, so they can pay back every single month, their monthly obligation to cover their housing.
Absolutely. And I would hope that most people know what a mortgage is, but yeah, that's great. A lot of houses have become a lot more expensive lately, so being able to outright buy a house is very rare for most people. So, what should people consider when they're buying a home? Like, what's the first step that they should take?
Yeah, the first step is actually to contact a mortgage professional that's licensed in their state. Um, I'm actually licensed up and down the East Coast, Maryland, Virginia, all the way down to Florida and upwards of Pennsylvania. So, yeah, a lot of folks think that, they may contact a realtor first, which isn't necessarily wrong, but the realtor will redirect them to a mortgage professional to go through what we call a pre-approval, which is having a conversation, filling out an application, which is called a 1003, and verifying their employment, their credit, and their assets, and basically getting an approval through an automated underwriting system. So they have a letter in hand to start the process, which the realtor can obviously set them up on a proper search in their certain city or county. Um, that's congruent with what they can afford and what they're looking to, the type of home that they're looking to move into.
Gotcha, gotcha. How do you calculate for a client how much they can afford? Do you do that? Like, say that this is your monthly income, this is how much, this is your down payment, so therefore, I guess it all depends, on the client's income, and those are things you walk through a client with.
Yeah, so the pre-approval is the maximum amount that they can afford, and then we can always back into a particular monthly payment. Um, Market rates are pretty standard across the board. Lenders borrow money from the same source, which is the government,
Yeah.
and most lenders offer similar products and rates, but it's about working with someone that know, like, and trust, and will be available to give you options and answer the phone because a lot of real estate is based off of time and locality.
Yeah.
Having a solid presence in your local county or nearby counties, because it's a lot of it is relationship based. Realtors like to work with direct lenders versus someone that is in maybe a different state at a bank or online. There's once again a lot of different mortgage companies, but it's really the person on the other side of that phone that can leverage relationships to get them not only the house they want and their offer accepted, but to get them to settlement without too much stress and anxiety.
Absolutely. I love that you're talking about with having and someone there for you who's not just transactional, but who you have a relationship that you've built with this person, that when rates come down, they can pick up the phone and say, hey, this might be a good time to look at things, or, keep up to date with their clients. And the client may, for example, tell you, oh, I got a raise, and that can change things with, how much you can qualify for a mortgage. So I really like that approach that you take. Can you talk a little bit about what types of mortgage loans are available and how they differ?
Yeah. So there's four main types of mortgage loans that are probably 95% of all real estate or mortgage transactions.
Yeah.
There's government loans, which are backed by HUD or the Housing Urban Development. A lot of people are familiar with the FHA loan. Um, then there's another government loan for veterans and military families called a VA loan. And I work with a lot of military families because I'm close to base and I just naturally have connections here at Fort Meade and through friends and family and realtors that are tied to folks that are involved with the military, whether they're active duty or they've departed. What we do for that is we pull a certificate of eligibility from the VA to see if they're eligible for a VA loan, and that's after they fill out a mortgage application. So VA loans are something that I do quite often, and I love working with military families and respect all they've done to serve our country and all the sacrifices they've made. So um, government loans, once again, FHA, VA. Then there's conventional financing, which is pretty much a cookie cutter loan for folks with good credit, healthy amount of assets for a down payment and closing costs. And then there's a rural, I always have a tough time saying that word, rural, RURAL type of loan, which is only available in certain type of areas called a USDA
Mm.
loan. Similar to VA, there's no mortgage insurance and you can put down 0%.
Mm. Wow.
But I'd say the majority of loans, are conforming conventional FHA or VA loans, and it's kind of across the board for all different lenders. A mortgage is a mortgage is a mortgage. Um, you know, all types of these loans are basically under certain entities, especially conventional loans, Fannie Mae and Freddie Mac, who purchase them in bundles after they're originated. So the government will buy them back and they're placed into what we call mortgage-backed securities. Um, and obviously that alongside the 10-year treasury, job reports, other economic factors impact interest rates on a day-to-day basis. So yeah, the government will buy back through mortgage-backed securities once a loan has funded thousands of loans at once and put them back into our economy through treasury bonds or T notes.
Gotcha, gotcha. Do you is all your mortgage business, is that all, do you ever recommend a variable? Do you always do fixed? Or like how do you determine that? And then like do you do 15-year, 30-year? And what do you, when you talk to clients, what do you tell them that I don't want to say recommend, but like when is it a good idea to do a 15-year? When's it a good idea to do a 30? And is, when's it a good idea to do fixed versus variable?
Yeah, so it's kind of like buying a car. You sit down with the financial um, manager who's
Yep.
working at a dealership, and they'll say, would you like your monthly payment to be higher and you pay it off quicker, over a 3, 4, 5 year period, or would you like the lowest payment but be making payments for up to 6 years in the automobile world?
Yeah.
As you said in mortgage, there's 10, 15, 20, 25, 30 year terms.
Right.
Um, you're going to get, probably a 0.5% better interest rate on a 15 year than a 30. And with that being said, you're going to pay a lot more per month on a 15-year note because it's 180 months versus 360 months, which is a 30 year.
Yeah.
And then you can find that happy median. So a lot of folks start with a 30-year mortgage and they can make double payments, or even if it's just one extra mortgage payment per year, that helps you pay off your mortgage, I think, 7 years sooner if you make one extra payment per year. Um, so yeah, that's the benefit of a 30-year is you have the lowest monthly payment. The disadvantage is it takes 30 years to pay off. A lot of folks don't have their mortgage for more than 6 or 7 years because they end up either selling or refinancing into a new loan. So another benefit that you can speak with a mortgage loan originator about is refinance opportunities, which can lower, the term or the payments. It can lower the interest rate, or you can use equity in your home to get cash out and use that for debt consolidation, which as a financial advisor, some triggers that you're looking for are credit cards, HELOCs, personal loans, second mortgages, um, other installment loans, like renovation loans, or sometimes clients have like pools that are also attached to their house as a second lien. So, as a financial advisor in your position and working with a mortgage professional, our lines are often crossing or
Yeah.
intertwined, if you will. And we can each look for ways that the client may use some professional advice to get rid of high interest debt through refinancing, or be able to manage their assets or their credit in a way that will help them be able to purchase a home in the future.
Yeah.
So I always tell people you can't really sell someone on buying a home. It's too big of a decision that impacts their whole lifestyle. But what we can do is just educate and give them the best advice. So when they are ready, they're placed in the best product and it's sustainable moving forward.
Yeah. Yeah. I love that. I love that. And it seems like it's really a case by case basis of, what's best for each client is individualized to their needs. So that really reiterates the point of talk to a professional that knows what they're doing, and that, it comes from an educational approach, and is it just going to put you into something that's going to make the most money for them, and obviously you want to avoid people like that as a consumer, but I think a lot of times you just get a feel for people, like the approach you take is you're educating people on their options, what might be best for their situation, learning about them as a person and their financial situation, and then you can kind of help them make the best decisions. So,
Yeah,
I
for
don't know if you want to
sure.
respond
And
to that, or I can ask my next question.
Yeah, yeah. I mean, it's all about just finding out, the goals and the needs of the client instead of pushing a product.
Mhm.
Um,
Yeah.
this way, they can build their net worth. I mean, me being realistic, it's tough to buy a home. I believe you need to make at least 80,000 combined or individually, to get what you want. And the costs that come with the down payment, which in certain cases, depending on their credit, income, and assets, we can provide some assistance through state or county programs or grants. So we utilize those programs in certain cases, to get people into homes, but we also want, once again, it to be sustainable. We don't want them to get into a house and be okay for 6 months, but then struggle to make payments the next 6 months or a couple years down the line. So it's good, just to see where you're at and see what we call, your debt to income ratio is, which is how much you make per month versus how much you owe. Um, just to give people a comfortable idea of what is going to benefit them in the future. So, yeah, there's also student loan programs that can eliminate student loan debt when you do buy a house through like a 5-year promissory note. The Maryland Mortgage Program specifically has a Smart Buy program, and I pulled up, a website today, and I saw Congress might be making some changes to student loan repayments, etc. So, besides just letting you get keys to get into a house or lowering your payment or getting out equity, there's some other special benefits that we can offer in the mortgage world.
Yeah. Yeah. That's great. That's great. Yeah. And you're talking about debt to income ratio. I think that's very important. Yeah, because you don't want someone who uses you as for your mortgage, and 6 months later they're out of the house. How many friends and family are they going to refer you? So it's in our best interest to make sure we do right for our clients, and yeah, because you never know who they know. So can you talk a little bit more? You mentioned like refinancing and like rolling, you know, things like student loans or like car debt or credit cards to into a mortgage. Is that possible? Or can you talk a little bit more about that?
Yeah, yeah. So, with a conventional loan or FHA or VA, there's an option called a cash out refinance. So basically, you can use your equity to completely pay off liens at closing. And that's something that we take care of at settlement with the servicers that you're currently using, whether it's credit cards or a second mortgage or installment loan. And just to keep it clean and use a clear cut example, you know, say that a home is 100 grand and that's what it's worth. For a cash out refinance, we can go up to 80% loan to value, with which in that example of a home appraising for 100K would be $80,000. It's the loan amount to the value of the home, pretty self-explanatory. And then that would be what you call your cap. Um, but let's say that someone's paid off half their mortgage and they owe 50 grand currently. That's their current mortgage balance. They can take out the difference, which is 30K between 50 and 80, to use to pay off debt, to go on vacation, to pay their kids' college tuition. They can use it for a variety of things, renovations. It's their money, and that's the beauty of owning a home is that compared to renting, that monthly payment is going to the landlord, where when you own a house, every payment as far as the principal and interest, um, or the principal per se, is paying yourself back, and it's almost like a second retirement account.
I see. I see.
So
That
you
sounds
can
very
use that
interesting.
you can use that money in the future, whether you sell or refi, it's yours to keep, and you can do whatever you want with it.
Very cool. Yeah, it seems like there's a lot of cool strategies out there that a lot of people don't know about. Now, I heard you talk about grants. Um, I think a lot of people listening would want to know, like, when should people like perk up and be like, oh, this is something I should really explore? What kind of grants are there being offered right now, and what kind of like demographic of people should be like, if they're listening to this, they're like, oh, he mentioned that, A, B, and C, I'm A, B, and C. I should definitely talk to a loan officer like yourself compared to, like what kind of grants are being offered? Um, Not like I don't want to say like right now, but like what in general, like when should people talk to, or what kind of grants should be explored? And is that something you only go through like a mortgage officer, or is there any other way to look for those grants? It seems like the best case would be to talk to someone like you for that information.
Yeah, and, keep in mind, a lot of the grants are income
It's
based. So
it's
you
kind of
can,
hard to hear you. You're I don't know if your mic cut out or what.
a lot of
Oh, there we
the
go.
the grants are income based.
Uh-huh.
So if you make too much money, or if your credit score is too low, or your front end debt to income ratio is too high, you may not be eligible. So everyone can use some common sense to prepare for buying a house, which is save as much as you can. I think if you save $7 a day, you end up saving an extra, 3 or 5 thousand per year. So what that looks like is just cutting out Starbucks or the soda at lunch. You can save money. You make sure you're making your payments on time so you have good credit. You can also work with a specific credit repair specialist to help you boost your credit.
Yeah.
Um, Also, you can make sure that you're buying your house before you buy an expensive vehicle or any type of, a major purchase that's going to show on your credit. You want to make sure that you ideally do that after you purchase a home because it's going to impact what you qualify for. Also, it's good to stick with your employer for at least 2 years and hopefully get paid a salary instead of hourly, because a lot of times with variable income, with bonus, overtime, or hourly pay, you have to average it against the previous year for certain programs. Especially FHA, you average over 2 years if you're paid by the hour or bonus or overtime. That also goes for conventional bonus and overtime. So, yeah, just common sense, save as much as you can. Um, Look for little ways that you can do that each and every day. Make your payments on time, make sure you have good credit, and get in touch with a loan officer so he can see where you're at. We don't expect that people are qualified and ready to go. We expect that we're going to be working with them and advising them for several months or years before they do buy. So there's never a sense of pressure or feeling like, oh, and if your loan officer is giving you the vibes like they're pushing you into a product or a home, that's probably not the type of loan officer you want to work with. That's kind of a red flag because this is a relationship, not a transactional business.
Yeah. Yeah, I like that. I saw a post yesterday on a some advice that someone received. You know, don't buy a very expensive car because you know that it's going to depreciate. If you were to invest more money, try to invest that into a new home because a home appreciates over time. Now, obviously, you know, you want to make sure, I like to stick to the rule of thumb of like 25% of your income should go to the mortgage. Uh, uh, and nothing too much more. Now, there, you know, prices have gotten so expensive that I'm willing to tell clients like, if it's a third of your income, you know, maybe we can get away with that. It all depends on the client's individual choices, but it's really, you know, a home over the long term. It, I don't want to say it's going to guarantee appreciate because compliance isn't going to like that, but over the long term, you know, real estate has shown to appreciate over the long term. So, um, you know, try not to invest in depreciating assets like a car, because most cars will depreciate, and try to invest in more things that will appreciate. Any final thoughts you have, Bryce, that people should be, that you want to close with?
Yeah, I mean, my final thoughts are, you know, once again, it's sometimes hard to get honest opinions. Work with someone that is realistic and, you know, can empathize that it's a tough time in the market. And if you can afford it and you're comfortable, home ownership is a slam dunk. But if it takes a little bit of saving and, you know, a couple years to put yourself in a position career wise, it's hard to words are hard to come by sometimes. Or, you know, in a professional opinion where um a professional position, you know, to buy a house, you know, sometimes it's worth waiting. Don't rush into it, you know, work with someone that sees both sides and kind of can see everything from a big picture instead of trying to once again push you into a product or into buying a house. But clients that, you know, I can tell are ready to go, um, make sure you work with someone local that has relationships with realtors on both the buying and the listing side, because with little inventory, it can make the difference of getting your offer accepted or, you know, losing out on your dream home. So yeah, it's good to work with direct mortgage professionals. No hate towards banks or credit unions, but often, you know, you're going to find better service elsewhere.
Yeah. Well, you worked with them for a while, so it's cool that you know kind of the tricks of the trade there, and you can help your clients with that. So,
Yep,
okay.
you got it.
All right. So, where can people best reach you?
Yeah, the best way to contact me is my cell phone, 301-466-7765. And my work email is Bryce, Gallagher at Fairway MC for Mortgage Corporation. That's fairwaymc.com.
Gotcha. Gotcha. All right, man. Well, thanks for being on. It was a pleasure, and yeah, man, appreciate it.
Thank you for your time.
Take
And
care. Yeah.
I definitely appreciate the opportunity and look forward to working with you in the future.
Me too. Me too. Take care, everyone. Bye.
Bye bye.